Most people think investing starts when you're rich. That's the lie. You do not need $10,000 to start building wealth. You do not need a finance degree. And honestly, your first $1,000 matters way more than your second $10,000. Because your first $1,000 changes something bigger than your bank account. It changes your identity. And most people waste that first $1,000 trying to look rich instead of actually building wealth. New shoes, random gadgets, weekend spending, one overpriced holiday, and suddenly the money is gone. But if you use that first $1,000 properly, it can completely change your next 10 years. Now here's the crazy part. Most beginners don't fail because investing is hard. They fail because they're impatient. They want to double their money overnight. They want the next crypto moonshot, the next meme stock, the next trust me bro investment. And somehow there's always a guy called Kyle telling everybody he found the next Bitcoin. Meanwhile, Kyle still owes people money from 2 years ago. That's the part nobody talks about. Wealth building is usually boring while it's working. The people getting rich slowly don't look exciting online. They're not renting Lamborghinis. They're not posting screenshots of fake profits. They're not yelling into cameras beside private jets. They're quietly investing. Every week, every month, every year. And eventually, that consistency becomes freedom. So where should you invest your first $1,000? If I had to start again from absolute zero, this is exactly what I'd do. First, I would not invest the entire $1,000 immediately. And I know, that sounds boring. But broke people think boring is bad. Rich people think boring is safe. Because if your car explodes tomorrow, or your phone dies, or your rent suddenly jumps, and your only backup plan is a credit card, you are not ready to invest aggressively yet. So the first thing I'd do, keep around $300 aside as an emergency buffer. Not because it grows fast, because life loves surprise bills. Life waits until you finally feel financially stable. Then suddenly your washing machine turns into a smoke machine. That's adulthood. Now the remaining $700? That's where investing begins. And this is where most people overcomplicate things. Because the finance world loves making investing sound confusing. Big words, fancy charts, people pretending they can predict markets. Meanwhile, most professional investors can't even beat the market long term. That's the funny part. So instead of trying to become the next Wall Street genius, I keep things simple, safe, and boring. Because boring investing is usually profitable investing over time. I'd focus on ETFs, exchange-traded funds. Now I know that sounds complicated, but it's actually one of the simplest ways to invest. An ETF is basically a giant basket of companies. Instead of trying to pick one winning company, you buy tiny pieces of hundreds of companies all at once. That means if one company struggles, your entire investment doesn't suddenly collapse. You spread the risk. That is what smart beginner investing looks like. In Australia, some of the most popular long-term ETFs are things like VAS and VGS. VAS gives you exposure to many of Australia's biggest companies, banks, mining companies, major Australian businesses. Then VGS gives you exposure to large international companies, companies across America and other global markets. So instead of betting everything on one company, you're investing across huge sections of the world economy. That is way safer long-term. Now, if you're in America, popular long-term ETFs people often talk about are things like VOO and VTI. VOO tracks the S&P 500, some of the biggest companies in America. VTI spreads even wider across the total US stock market. Again, simple, diversified, long-term. And if you're in the UK, people often use ETFs like VUSA or FTWG. Very similar concept. Broad market exposure, long-term investing, set and forget. And that is the key. Set and forget. Not checking your phone every 11 minutes. Not panic selling because the market dropped 2%. Not watching dramatic finance TikToks at midnight. Real investing should honestly feel a little boring. Because if your investing strategy feels like a casino, you're probably doing it wrong. Now here's something really important. The stock market does not go up every single year. Some years are amazing. Some years are average. And some years, your investments might actually go backwards. That is normal. Long-term investors understand this. Over long periods of time. Historically, broad market ETFs have generally grown much better than basic savings accounts. And many long-term investors aim for around 8 to 10% average annual growth over long periods. Not every year. Average. That means one year might be up 20%. Another year might be down 10%. But over 10 years? History suggests diversified long-term investing has generally rewarded patience. That's the part people struggle with. Patience. Because everybody wants fast results. But real wealth usually grows slowly, quietly, and consistently. That's why apps like eToro, CMC Invest, Vanguard, and Betashares have become popular with beginner investors. They simplify the process. You can buy ETFs, automate investments, track your portfolio, and most importantly, remove emotion from the process. Because successful investing is usually less about intelligence and more about consistency. The goal isn't becoming rich overnight. The goal is becoming financially stronger year after year. Imagine investing every payday for the next 10 years, even small amounts. That consistency can become incredibly powerful over time because of compound growth. Your money starts making money. Then that money starts making money. And eventually, you stop relying only on your paycheck. That's when investing starts changing your life. Not because you got lucky, because you stayed consistent while everybody else chased hype. Automation is huge. Because investing should not depend on motivation. Motivation disappears fast. Usually right around payday, right around online sales, right around food delivery apps showing special offers. That's why automation matters. You remove emotion from the process. Every payday, money automatically moves into investments. Even if it's only $20. Because consistency beats intensity almost every single time. People massively underestimate small amounts invested consistently. They think investing only matters when you're rich. But investing is how people become rich. That's the entire point. And please, stop waiting for the perfect time to invest. The market does not send invitation emails. Nobody wakes up one day with complete confidence. Everybody feels nervous at the beginning. That's normal. Beginner mistake number 1. Trying to get rich too quickly. Beginner mistake number 2. Never starting at all. Now I already know the comments coming. What if the market crashes? Honestly, then things go on sale. Long-term investors don't panic at discounts. Imagine walking into a store and everything is 30% cheaper. Most people would get excited. But when investments go on sale, people panic. That mindset shift changes everything. Another question. What app should I use? Honestly, the best investing app is usually the one you'll actually keep using. Simple beats perfect. You do not need the fanciest platform. You do not need 12 monitors. You do not need to stare at charts all day. You just need consistency. That's it. Your first $1,000 is not about becoming rich overnight. It's about becoming the type of person who invests consistently for years. Because once you build that habit, everything changes. Future you becomes wealthier, calmer, more secure, less stressed. And trust me, future you will be very grateful you started today. And before we finish, I need to quickly say something really important. This video is for general educational and entertainment purposes only. I'm sharing broad investing ideas and strategies that many long-term investors use. But everybody's financial situation is different. Your income, your goals, your debts, your country, your taxes, your risk tolerance. All of that matters when making financial decisions. So please, do your own research before investing. And consider speaking with a licensed financial professional or advisor in your own country before making major financial decisions. Because investing always carries risk. Markets can go up, and markets can go down. Past performance does not guarantee future results. The goal of this channel is to help simplify finance and help people think longer term about money, not to guarantee profits, and definitely not to encourage gambling-style investing. Build slowly, invest consistently, think long-term. That's how real wealth is usually built. If this video helped you simplify finance, like and subscribe for simple finance in minutes. This is Bite-Sized Finance.